forward that because Adani group of companies, again, they are very different companies in terms of their business, in terms of the strategy, in terms of the business cycle. But collectively, numbers have been decent and they have been more than satisfactory. For a group where 6 months ago there were no buyers, now sense, semblance, logic, and more importantly, belief seems to be making a comeback. For me, what really is important is that they made an acquisition. Now just imagine if a group had a problem, why would they make a 6,000 crore acquisition? The fact that they've acquired an asset, it means that they can service their debt obligations and they can service their debt to equity ratio. For me, I think that is like the most important key takeaway. But we'll talk about specifics here. Deven Choksey joins us now. Deven, good to have you on ET Now. Thank you for joining us. Which to your mind is the strongest Adani group of numbers so far if you have to analyze the performance for the quarter gone by?
Well, I think on the size of the balance sheet, if one has to look at the Adani Enterprises balance sheet, I think definitely demands an attention at this point of time. When I look at the numbers, I think I find that on an annualized run rate, I think based on the quarterly reported numbers of first quarter, the company would eventually end up making an EBITDA of around 12,000 crores without, I think, taking into account, I think, the additional businesses which are getting started in different parts of the year. So I think based only on the first quarter result, I think they're basically becoming 12,000 crores. The other part is, I think, Adani Power, which is, again, an important one because I think, again, if you look at the numbers which have been reported on the EBITDA and the profit front, you find that I think somewhere around 18,000 crore worth of EBITDA for the current financial year is in making based on, I think, these numbers. And if you end up taking ports number, which will come eventually, so I think all put together and without, I think, factoring cement at this point of time, if you put all these things put together, I would think that I think the group is basically heading in the direction of making around 55-60,000 crores of EBITDA in the current financial year. Now, should that be the situation, then probably I think the entire equation, as far as I think the business condition and outlook for the company and the balance sheet part of the company is concerned, is getting changed. So that is more important. And I see the entire infrastructure portfolio of the company at the group level to begin with, and then respective companies thereafter. And I believe that I think this is the approach that one will have to carry because there is an existing, I think, huge amount of synergy between different infrastructure businesses that they have created.
Okay. Let's analyze the acquisition and the numbers what we've got. Adani Port. This, in a sense, is the most robust company in terms of cash flow and in terms of the business moat it represents. What do you make of that business going forward?
In fact, I think an absolutely very convincing business model that they have created between the East Shore and the West. I think they have got almost more than 15 ports into their portfolio now, and not including, I think, the overseas port acquisition that they have done. I would think that I think this is one strategically built business, which is basically taking care of the entire logistic part of the activity and for the groups, all the businesses. Say, for example, for cement, I think the cement between, I think, the eastern to western coast, I think is shipped, I think, through the sea route, which Ambuja started in good old days, I think, this particular model. I think which I think now basically Adani's company. So they are actually, I think, going to get the leverage out of the port into the cement businesses systematically. And so would be the situation with various other commodities that they are basically handling, including for their customers. Going forward, I think different other commodities, be it in the metal segment with copper or be it in the other petrochemical segment in which they want to foray into, or even for that matter, even the fertilizers, I think, which they are importing for the other customers of theirs. Different ports are playing a meaningful role. Along with that, I think the Dahej port, or for that matter, Mundra port, and I think the cluster of the 17 ports that Gujarat belt has acquired. I feel that I think this particular company is strategically well positioned from the business point of view. So you are absolutely right in putting across a narrative that this is one of the most robust models that across the group rather, this company has built. In my viewpoint, I think that is one model I think which will probably give you continued cash flows of around 55-60% of EBITDA margin continuing in this business.
Okay, now let's understand the spirit behind the Sangvi acquisition. The fact that they've acquired an acquisition 6,000 crore broadly at a time when the group was criticized for debt. Is this an indication that the group feels confident of servicing future debt and even an acquired asset?
Yes, and I would think so. Look at the numbers, I think, which has come out. The limestone reserves that the Sangi has got is about 1 million ton, which is fundamentally important in the cement business. I think if you have got one of the key ingredient in for limestone, I think that is the first thing to start with. The second most important ingredient is the power, which is coal. And I think coal is one thing which they have the mining rights of coals in the country, and they also have their own import coal from the Indonesia and the Australian side. So to a greater extent, I think you have the second commodity, which is coal available, along with the limestone in the cement business, which they could feed into the Sangi acquisition. Third, the Sangi is bringing along with the captive jetty and captive power plant for operating the cement business. So input is definitely taken care of. Probably, I think this company could not manage the kind of resources that they carried, and this is where Adani fits in, I believe, because I think they have got the strong ability to manage the input resources. Then comes the logistic part of it, wherein you produce the clinker and then make the cement thereafter, and you ship it, I think, from eastern coast to western coast, even for the purpose of go-to-market kind of a strategy, which is basically assuming higher amount of transportation cost. Through this mechanism of logistic on the port, I think they are also being taken care of. So that part, I think, is again, I think, very systematically done as far as this business is concerned. So on one side, you manage logistic cost. On one side, you manage, I think, the input cost. And in the process, I think you create the marketing fabric, which is ACC and Ambuja combined put together, is already in place. And not to forget, I think one more area which I feel, I think, which is quite impressive, is the cement in a prefabricated form, I think, for the products which are required for construction. Now that is going to be a game changer. Currently, cement is being used as either as a cement mix or I think as a retail bags. But more importantly, once you have got the prefabricated components, I think which are required for the construction part, I believe that I think it could probably also result into higher margins for the company. So I see a strategic fit for ACC Ambuja combined along with Sangi into the portfolio as far as Adani's move is concerned.
Let's understand Adani Enterprise, because that in a sense is the incubator that's giving birth to the group companies. What is the right way of looking at Adani Enterprise? Because some would say that this is one company which wanted to raise cash. The FPO did not go through. What happens there now?
So again, think first and foremost, this particular company being an incubator company, they will continuously require the cash flow to come into the books by way of either operating cash flow or by way of, I think, the capital cash flows, I think, which they have started bringing in through the GCQ kind of investors who have started putting money into the group and the company. So that is going to remain a condition going forward as well, because as they rightly do, I think they incubate businesses here, be it road asset, be it now data center assets, whatever they call it as mining assets that they have inside the company, or even for that matter, I think the newer assets which they are building in form of copper production or going forward petrochemical lines of activity. Each of these businesses are becoming part of Adani Enterprises. And as the group is on the record, including I think the water and the water management business, I think which they ultimately want to bring into the public domain, which is going to be incubated from Adani Enterprise. So if all these businesses are getting incubated here, and by 2026-2028 period, in which if they want to demerge all these companies systematically and start giving it into the public domain, in my viewpoint, I think there is a significant amount of wealth creation for those investors who have got a deep pocket for investment into this kind of businesses. If should they remain invested into this kind of businesses for longer period, I believe that I think there is plenty of unlocking of value which is happening in this particular business. So certainly, I think one caveat that I think instead of retail investor, I think if you are an institutional investor like pension fund, insurance fund, sovereign fund, or a large size hedge fund, probably I think for you, I think this kind of business is definitely more meaningful because it is producing unlocking of the value in coming years.
Adani group of stocks by any yardstick, when before they crashed, they were expensive. Any yardstick, price to book, P multiple, debt to equity. Then they corrected 40-50%. Now they've come back. What is the value now according to you based on individual companies and the market benchmarks?
So I think I can probably add one more point to I think how the value should be seen in the infrastructure businesses. In my viewpoint, I think the value of infrastructure businesses should be seen from the point of view of the current asset price, because infrastructure businesses assume significant amount of land asset to begin with, and after the land asset, I think on the top of it, the operating assets, whichever is being created, either be it transmission line or be it port or be it roads or airports or whatever. Each of these operating assets will keep generating the revenue, and on that basis, I think you can apply EV to EBITDA numbers and probably I think give the valuation to the companies. But more importantly, in my viewpoint, I think since they have been building these assets for last 20 years, and assuming at that point of time, I think from different price point of dollar to rupee, they have got this asset built in. If at all, I think if I assume that I think somewhere around 55 to a dollar is the price at which I think average price at which I think they build all these infrastructure assets. Today, if anybody wants to buy into these infrastructure assets, I think they have to pay a price of 80 to $82 to a dollar. I think that is a price that you have to pay. Now, if that price is not reflected into the stock price, I think that is where I think the stock becomes cheap or inexpensive, because these assets have already started producing revenue. Once I think this particular price is factored into the stock price, then it is seen expensive. But according to me, it is not expensive, because the replacement value of these particular assets, and given the fact that they have taken 20 years to build these assets, is not going to come cheap to anybody. So that particular reconciliation has to happen in the minds of the investor, which probably has not happened. And rightfully so, they have not probably applied their mind, I believe, because they are not infrastructure investors. I think they are basically retail investors, even they come through mutual fund. So from that perspective, I think this correction in the understanding of the subject business of infrastructure has to happen. I don't see these assets expensive, given this particular rationale that I see of replacement value of assets at a current dollar price.
All right, Deven, I really appreciate your time.
This first